it's my assumption based on variety of dynamics, not just silver, but also its relative performance to gold, that silver could gush past the old $50 highs of 1980 and 2011 and reach up into the mid 60s to $70 area before it even pauses. So in other words, I'm arguing the case here that if you push this beast up just a little bit more, and you're going to unleash it. I think this time when you got up there, you're going to blow it out and go into the mid 60s or so before you even pause. And that's not the end of the bull. That's just this surge.
Since 1980, silver has only touched the $50 mark twice, both times in sudden speculative bursts that quickly evaporated. In 1980, it was the Hunt brothers squeeze. In 2011, it was post-crisis monetary panic. In both cases, silver reversed violently and left investors burned. Experts believe we are again upon one of those glorious moments for silver. But Michael Oliver, founder of Momentum Structural Analysis, argues that this time is fundamentally different. According to Oliver, the technical structure of the silver market, combined with its extreme undervaluation relative to gold, suggests we are not facing a short-lived spike, but the opening stage of a multi-wave breakout that could see silver surge into the $60 to $70 range before it even pauses. Let's be clear, this isn't just price speculation, it's grounded in decades of intermarket momentum analytics. Oliver points to silver's current ratio to gold, which recently fell to under 1%, a rare historical extreme. To put that in context, over the last 50 years, the silver-to-gold price ratio has spent more than 2 decades above 2%, which implies that silver would have to double just to return to its historical mean. And here's the kicker. This breakout isn't being driven by retail mania. Quite the opposite. Sentiment in silver remains low, mining stocks are unloved, and most investors remain focused on tech and AI hype. Yet under the surface, long-term momentum indicators are quietly flipping. Oliver's models show that a weekly close near $34.80 to $34.90 could trigger a major breakout signal, not only invalidating resistance at $35 and $36, but setting the stage for what he calls a momentum gush. All of this is unfolding as the US dollar breaks a 2-year sideways range and heads for a possible collapse back to the 70s level. Add a crumbling bond market, rising central bank gold buying, and geopolitical instability, and you've got the perfect conditions for monetary metals to resume their historic role as real money. In this video, we'll break down Oliver's latest silver forecast, compare it with long-term gold dynamics, and explore how this potential breakout could reshape the precious metals landscape over the next 12 to 18 months. If you're looking for evidence-based, market-tested insights, not hype, you're in the right place. Hit the like button to support independent analysis. Subscribe for weekly breakdowns on gold, silver, and the collapse of fiat illusions. And tell us in the comments, are you buying silver here or waiting for confirmation above $36? We appreciate all your support and hope you enjoy the video.
What is front and center for you on your radar?
Well, it's silver. I've stressed that monetary metals are the place to be. Silver's been an underperformer, so have the gold miners. This is relative to gold, that is. They're underperformers. I think that's shifting. It's clearly shifted in favor of the miners versus gold over the recent action. Okay, silver, I think, is making a turn in terms of outpacing gold again. It's very much underpaced gold over the last 3 or 4 years. I think it's about to turn from very cheap relative levels to gold. It was under 1% of the price of gold a month ago. Yep. Meaning if you divided an ounce of silver and an ounce of gold, it came up less than 1%. Okay, that's very low. In fact, in the last 50 years plus, 21 of those years have at least seen silver at 2% of the price of gold. So even if you just went to a norm of 2%, that's doubling in the current value of silver to gold. Okay, and I think we're going to do that. But as far as the net price action and the momentum action of the metals, they've been in uptrends, obviously, since 2015 with the silver and the miners have had a correction between 2024, which gold went sideways and then, et cetera, resumed. Silver's now pushing at this week's high up to 35 again. Didn't quite touch it. It touched 35 back last October and dropped. It touched 35 again in March and dropped. And we had a cleansing drop, as you can see on that chart there. These are what, weekly or monthly bars here?
Yeah, these are weekly.
Yeah, weeklies, yeah. And so you can see that last plunge we had, that sharp one, that was early April. That's when everybody out there thinking, oh, silver must go down with the stock market, okay? And so while gold pulled back single-digit percents then, silver dropped from $35 to $27.5, much of that occurring in 2.5 trading days. So it was a real panic, an orgy. And it cleansed the price chart, meaning that low took out the December low. So anybody who had their sell stops below that last low got wiped out and immediately reversed back up. Okay, it was a bear trap. And now you can see we're pushing at the highs up there. Now, anyway, we got up to 34.97, I think, yesterday. If you touch 35 again on using July contract, that's right. What's called on point and figure charts, price guys that keep those things, $1, $3 down ticks, $1, et cetera. It's a double top. If you go back there a third time, it's a triple top, but it won't be a triple top. It'll be a triple top breakout by touching 36. So the price guys are going to get all excited if you see 36 because it'll be a blowout of the prior dual highs. Momentum, however, the long-term momentum that we're monitoring, says that if you can close this week out just around yesterday's high, around 34.80, 34.90. Right now, I think we're trading, we speak, 34.55 or something. You close the week out around yesterday's highs, and I'm going to get a momentum breakout that says you don't wait for 35 or 36. It's going to go. Okay.
Wow.
And I think when you go, it's my assumption based on variety of dynamics, not just silver, but also its relative performance to gold, that silver could gush past the old $50 highs of 1980 and 2011 and reach up into the mid 60s to $70 area before it even pauses. So in other words, I'm arguing the case here that if you push this beast up just a little bit more, and you're going to unleash it, and I don't think it's going to have any effect at $50. I think anybody who looks at those highs as highs is meaningless. First off, those highs when they occurred were so phantom and so brief that they almost don't even constitute highs. In other words, you were up there like one day and you evaporated. I think this time when you got up there, you're going to blow it out and go into the mid 60s or so before you even pause. And that's not the end of the bull. That's just this surge. So anyway, that's the dynamics I'm looking at. Now, what's going on around it is what's important. We've got the dollar, which has been a non-player for a couple of years because it was stuck in a 7% range between 23, 24, and into early 25, between about 100 and 107. It briefly ran up to 110 one time in a brief false breakout, but basically was in a range. So you could see that clump of ink there, that quiet little clump of ink. It's a narrow range for 2 years. So it wasn't a factor in impacting other markets. There wasn't enough going on in the major Forex markets to have an impact on bonds or on the stock market. But in March, that first big down arrow you see there, the down candle, right in the middle of that range, we closed at 104.21 right there. Yeah, that was March close. We got bearish then. We said, okay, you've broken an annual momentum uptrend. You can't see it on price, but on momentum, you broke it. Now you're trading there, at 99, 98 level. You better get out of here. If you don't get out of here, this breakage is going to continue, and we think we're going to go back to the lows. At least the lows being a couple decades ago down around 70.
When it comes to market timing, most investors focus on headlines, price levels, or even fundamentals. But Michael Oliver's approach is different. His entire framework is built on momentum structural analysis, a discipline that examines how price behaves relative to its own trend over time, rather than fixating on where that price currently sits. Why does this matter for silver? Because while silver may look stuck in a range, Oliver argues that the underlying velocity of its move is shifting, and that momentum breakouts often precede price breakouts by weeks or even months. In fact, in past cycles, like 2003 and 2004, or 2009 and 2010, silver's price action was deceptively quiet right up until it wasn't. Then came explosive moves. Silver tripled in a matter of months. What makes now especially compelling is how silver is behaving in tandem with gold. Gold has already broken to all-time highs and stayed there, a rare and powerful signal. In typical bull runs, gold leads, and then silver super leverages the move. But here's what's key. Silver isn't just waiting to catch up. According to Oliver, it's building pressure below the surface, and once released, the catch-up effect tends to be not just linear, but parabolic. This is also about supply and liquidity. Silver is notoriously thinly traded compared to gold, so when even modest capital flows into the silver market, especially from institutions or ETFs, it tends to move violently. Add to that the fact that mining production remains flat, while industrial demand, especially from solar and green tech sectors, is rising, and you've got a classic supply squeeze setup. As we go into this next segment, listen closely to how Oliver explains the momentum-based thresholds, especially the $34.80 to $34.90 range, and why clearing it would set off not just a price move, but a systemic shift in positioning across the market. Let's dive in.
Every time gold makes a high, there's this crowd on the internet, analyst crowd, that says, oh, that's the top, it's gone too far, it's got to go down, or it's going to have a major correction. And like a recent month or so, I think all the crowd has been saying, we're going back to 2,800. Mm-hmm. So there was a major shelf back there, whatever. Anyway, so we had this quick drop that occurred. This must be weekly here.
Oh, it's daily, actually.
Oh, is that daily? Oh, okay. Yeah. Okay. You had that quick plunge there and immediately recorked back up to near the highs again. Now, if you touch 3,500 again, there was one trade up there that reached 3,500.
Yep.
People are going to say, well, I guess it ain't a top. Okay. And this has been the pattern of behavior ever since 2024, when we put out a report in March of that year. So 14 months ago, that said, gold is awakening. It's going to resume its bull trend. At that point in time, it had been capped just above 2,000 for 3 or 4 times. You got up above 2,000, knocked down. In March of 2024, it moved up through 2,000 again, and it, boom, 3,500. But in the process of getting to 3,500, you'll find multiple spots where there were 5 and 10 or so % drops. And each one of these, most price technicians thought, oh, that's it. That was the top. Or we got to undergo a major correction. It never seemed to materialize in the way they thought. You never got as deep as they thought it would go or stay as low as long. And I think this time when you touch 3,500 and go back to top tick, people could just finally give up on this notion that somehow gold is overbought, because it certainly isn't. And also, if you ever get to 3,500, you can bet silver is going to be $36 to $38. Okay, it'll be blown through its structures. I think we'll get acceleration at this point, meaning there's a point at which the arm wrestling advanced in gold and silver since 14 months ago. Remember, silver then was $25 to $26 in March of 2020. So, you can complain that it's lagged to gold, but it's up pretty good since March of 2024, $25 to $26. Now we're trading just almost short of 35. I think this staircasing process will end. And instead of 3 steps up, 2 back, you're going to get like 8 steps up, 1 back type of pattern. And I think that will be associated with probably these other factors we've been talking about: acceleration, decline of the dollar, sense of crisis about T-bonds, stock market uncertainty, all those factors will cascade together and create, I think, a more sharply ascending pattern in the monetary metals. Historically, if you really go back and look at like the XAU versus the S&P, there are times when, yes, it will suffer a drop when the S&P does, but its major upside trends are quite often opposite. And what people don't notice is that from the 2015 low in XAU, when it was down, I get 40 points. What do you got here? Where we got 2015. What's that low back there? 40 something, I think.
Yeah, it's
yeah. I mean, what are you? 200 now. Okay,
yeah.
You're 200 now. Okay, now if you measure that where you are right now, and it's up more than the stock market, but nobody gives it credit because of all these pullbacks. And things.
430%.
Yeah, that's a pretty good
5X.
move since 2015. Back in 2015, I think the S&P was 2,000 area, something like that.
So if you compare them together, go back to 20. Yep. So.
But anyway, but nobody's pounding the table about the gold miners. And yet
Yep.
in reality, if you measure the metrics like GDX versus S&P or whatever, and by the way, the recent action of the last 4 or 5 months has caused a spread breakout, meaning upside versus the miners relative to the S&P on a performance basis. Not just the bigger picture, but there was a pullback during the years from 2020 through 2024 where you could see that XAU went sideways while the S&P went up. So during that time, it underperformed the S&P by going sideways while the S&P went up. It's broken out of that pattern now on the spread, indicating XAU and GDX are now an outperform trend relative to the S&P. So they're back in gear again. And I think they'll be a better place to be than gold.
Michael Oliver doesn't deal in hype. He deals in data, and what he's outlined here is nothing short of a market inflection point. When silver crosses that $34.90 level and sustains above it, the technical structure doesn't just change, it fractures in a way that historically leads to outsized gains in compressed timeframes. And gold? The momentum picture there is even more startling. Gold has already shattered its 2020 highs and is now consolidating above all prior resistance, a clear indication that institutions are reallocating quietly while the public remains asleep. According to Oliver, this isn't a top, it's a launch pad. His models now point to $8,000 to $10,000 gold as not only possible, but likely within the next few years. And if silver does what it usually does, overshoot, then a move to $200 per ounce isn't some fringe fantasy. It's what the technicals are screaming in the face of systemic complacency. The truth is, most investors will miss this. They'll wait for CNBC to confirm it. They'll wait for Wall Street to issue new buy ratings. But by then, silver will be at $60, maybe $70, and they'll have missed the asymmetric window. So the question is, are you positioned for what comes next? Not just financially, but mentally. Because parabolic moves are emotionally brutal. They shake out the weak, test your conviction, and rarely offer second chances. Michael Oliver's work is a reminder that real wealth is built not by chasing momentum after it's obvious. If you're ready to take the red pill on silver and gold, now's the time to dig deeper. Subscribe to our channel, share this video, and drop your thoughts below. Where do you see silver headed in the next 12 months? Thanks for watching, and see you in the next one.